So when is the best time to invest? Well, maybe you've heard the saying, it's not about timing the market, but time in the market. And honestly, that couldn't be more true. So when is the best time to start investing? Well, now. It's always now. It always has been now, and it always will be right now. The sooner we start, the more we stand to gain, thanks to the magic of compound interest. Now, to illustrate this, I wrote you a little poem that I call The Tale of Two Investors, the story of you and me. So let me read it to you. There once lived a person named you who lived right next door to a person named me. This is the story of how you and me approached investing. You started early. At the age of 22, you began investing $500 every month. You were consistent and disciplined. You contributed each month for 10 years until you turned 32. Then, for reasons only you know, you just stopped investing altogether. But here's the interesting part. You left the money alone and you just let it grow, untouched. Meanwhile, me was a bit of a late starter. Me didn't begin investing until me was 32. But once me started, me was committed, just like you. Me invested $500 every month and kept it up consistently until me turned 65. Now let's fast forward to age 65. You might think that because me invested for more years, me would end up with more money than you. But here's the power of compound interest. It rewards those who start early. You, who invested for just 10 years and then stopped, ended up with an astonishing $4.3 million in their investment account. And me, who invested steadily from age 32 all the way to 65, ended up with only $1.9 million. So even though me invested for over 30 years, 3 times as long as you, the earlier start gave you a huge advantage. Now, this story clearly shows that when it comes to investing, time is your greatest ally. This exact poem that I wrote got my 2 older boys to start investing right now, and they're 22 and 24. Now, let's talk about something that trips up a lot of people. They try to time the market or timing the market. Almost everybody who gets started investing at some point has the tempting thought that they can just time the market, that they can choose the best time to throw their money in. That if I could just buy on days when the market is down and then sell on days when it's up, my performance would be astronomical, right? Unfortunately, trying to predict when the market's going to go up or down is honestly a losing game. Nobody, and I mean nobody, can consistently time the market. The way better strategy that's going to really help you here is called dollar cost averaging, or DCA. So here's how it works. Instead of dumping a large sum of money into the market all at once, you're going to invest a fixed amount at regular intervals, whether that's weekly, monthly, or quarterly. So let's take a $1,200 a year example and pretend we have 2 investors, Dollar Cost Dave and then Timing Tim. They each have $1,200 to invest over the course of a year, but they take very different approaches. Dollar Cost Dave is going to take his $1,200 and invest it $100 a month, regardless of the market price. He doesn't try to time the market. He just wants to get his money into the market consistently, come rain or shine. Then we have Timing Tim. He believes that he can predict the best time to invest, so he decides to put all of his money in the market at once, in January, let's say, when the share price of a stock might be $10. So what's likely to happen over the course of the year is that the market, this stock, will go up and down, as you can see in this chart. It jumps up to $12, then back down to 10, down to 9, 8, 7, up to 11, down to 8. It stays there for a few months and finally finishes the year back at $10, exactly where it started. In the end, Timing Tim earned a 0% return on his money. He still has his $1,200, but no profit at all. However, Dollar Cost Dave, who invested $100 every month, well, he came out ahead. In the first month, when shares were $10, he bought 10 shares. The next month, with shares at $12, his $100 could only buy 8.33 shares, and so on. And each month, as the price went up and down, he kept purchasing as many shares as he could with his $100. At the end of the year, even though the share price finished exactly where it started, Dave's consistent investments added up to $1,328. And here's the interesting part. Dollar cost Dave's approach means that when the market was down, he was buying more shares. And this is a strategy that I love to use myself. I hold individual stocks in my portfolio, and almost every time the market drops by more than 10 or 20%, I don't sell my existing shares. I buy more. I double down. As long as I still believe in the company, because what inevitably happens is this rebound effect. And the second huge benefit here is that dollar cost averaging helps investors stay disciplined. It mitigates the risk of market volatility and helps you avoid the trap of trying to time the market, which is just going to lead to way better long-term returns. Because remember, as we said before, it's all about time in the market. The most important thing, though, is to just get started. Whether you're investing a little bit at a time or all at once, it's more important to be in the market than to try to wait for the perfect moment. The best time to invest was yesterday, and the second best time is today, right now. So don't let fear or indecision keep you from starting. Focus on being consistent. Focus on putting your money to work. And over time, the results will follow. The truth is, time in the market beats trying to time the market. And every year that you wait is a year you could have had your money growing and compounding. So start small if you have to, but start now.